Hi guys, this is GCM, Global Capital Management. I'm here today to talk about an investment product called a bond and how it can maximise your earning potential, increase your investment portfolio and increase your client bank. And overall, I want to give you an overview and technical information on the bond to ultimately give you the confidence to pitch the bond to your clients with authority and knowledge. Now, typically, many of you guys are property agents and the average earning commissions are up to 3-4%. The great news on the bond is typically they pay in excess of 5%, sometimes rising up to 8, 9 and 10%, which I'm sure you'll agree is excellent. So, how does a bond work? A bond is often referred to in the industry as a debt instrument. It's a controlled and efficient and often cheap method of raising capital for an SME looking to fund a project or invest in the growth of their business. So the bond is essentially an IOU between the investor, the client, and the borrower, the company. It usually pays a coupon over a fixed term. So at the end of the term you receive back your capital and that coupon. So it's a very structured product and is often a very high yielding product. The bond is often listed on a stock exchange, typically overseas, for example Frankfurt, Ireland, Cyprus, to name a few. In the UK, the bond would be regulated under Section 21. Now, that doesn't mean that the bond is regulated per se, it just means you can market it in the UK. And you can market it to a finite group of investors. Sophisticated investors, high and ultra high net worth investors. So a sophisticated investor would be someone who has experience in the investment marketplace, and the high and ultra high net worth would be a client who has a minimum amount of cash or assets. Now, the bond providers we deal with are not regulated by the FCA, so that would mean the bond holders would not be entitled to claim under the FSCS scheme. However, the entities behind the bond are regulated, so that could be administrators and even the fund. So there is a level of protection there for your clients. Another level of security for your clients would be the risk rating, which is applied by a separate accreditation company, and that measures the financial strength, stability and the general outlook for that company. So, let's have a look at the questions often asked in and around the bond. So, why do companies use bonds for funding rather than the more traditional methods such as bank loans, etc.? Typically, these companies use a multi-sourcing model to raise capital. So they raise capital from a number of sources. Now that could be bank funding, which is often high interest payments, strict lending criteria and a lengthy process. It could be peer-to-peer lending, so private lenders facilitated through an online platform, which generally has more competitive rates than banks and also pays out funds quicker than banks. And then there's another popular way, which is raising money through bonds, so bond issues. Bond issues are raised to the bondholders over a fixed term, and the bondholder would receive a coupon payment over that fixed term or at the end of the fixed term. A typical term on these bonds would be between 36 and 60 months, and a typical coupon payment could be between 6 and 12%. Often paid annually, sometimes paid biannually, or sometimes no income is paid over the period of investment and it's paid at the end when the capital is returned to the client. So the capital and the coupon payment is made payable to the client at the end of the term. Often the yields, being as high as they are, mean that the brokers receive generous commission payments. So the client wins, the agent wins. So how does security work on a bond? Well, the bond is appointed a security trustee, and all of our bonds at GCM are asset backed. So they are asset backed, first line of protection. Second line of protection, they are applied with a risk rating from an accreditation body. Now that accreditation body could be a company such as Standard & Poor or ARC Ratings. And as mentioned before, they look at the whole company financial strength, stability, general outlook. They look into the accounts forensically and they apply a rating. Ratings are determined by the state of the company in terms of stability, strength, financial stability and general outlook. The ratings range from AAA plus down to D's, E's, which obviously at GCM we wouldn't touch any bond below a C rating. So the company would make sure that the bondholder is protected, and these securities will give you and the client's confidence in stepping into the bond market. So your clients looked at this proposition, they're very interested. So what's the buying process? Well, it's a very simple application process involving a suitability test to determine if the investor or the client is right for this type of investment, i.e. if they are a sophisticated investor or a high net worth client. If they pass that assessment, they will then have an anti-money laundering assessment, which again will determine if they're suitable. Identification is required, and obviously proof of funds and where the funds are coming from. And then finally GCM will submit all the paperwork for you following a full audit, and then commissions will be paid as soon as cleared funds have hit the clearing settlement agent, and normally that will be a 14-day period from submission of paperwork. Thanks for listening, guys, and I hope I've provided you with a comprehensive overview of one of our debt instruments that we have at GCM, the listed bond. And I'd like to welcome you to GCM and expand your portfolio, your horizons, and happy hunting, guys.